Okay, peeps, welcome back. So today we're going to be talking about whether the YieldMax ETFs are still worth buying and what we're doing with the YieldMax ETFs. This is going to be the YieldMax weekly TA review as well. Let's get it. So the first chart that we have pulled up here is Tesla. I know it's been a while since we've done this, but the spot Bitcoin ETFs have come out and we've been laying a little bit more heavily into crypto because of the crypto cycle, and we've told you guys all this already, so it shouldn't really come as a surprise. But anyways, we have finally gotten a chance to get around to these, so let's get into it. So as you guys can see, Tesla has dipped below the support. Whether it's going to come back up and come back above it remains to be seen. That, again, depends on the underlying at this point. So we're going to take a look at Tesla before we close out the video. But I would say that this support is unfortunately no longer valid. But again, this could be a fake out. Tesla could come back up and then Tesla could go up with it next week. We really just don't know at this point. We'll have to wait and see. But the thing to think about is the cheaper that share prices generally are, the more passive income you get for your money. So I don't know. I mean, if Tesla is $10 and it pays 50 cents a share, I mean, it could still potentially be worth it, or at least have somewhat of a use in someone's portfolio. So Coney, as you guys can see, it kind of really just was absolutely moonshotting, got crazy, got up to $30, and then it kind of had a blowout sell-off. I mean, this thing really just tank-olaed big time. But you got to understand the spot Bitcoin ETFs, at least in the immediate short term, were kind of a buy the rumor, sell the news event. So it's not really surprising that this happened. I'm not saying that it is actually a sell the news event. I think it's a little bit early to say that, but we'll just have to wait and see how that plays out. But as far as I'm concerned, I mean, we're right in between these two zones here. I would say this is a perfect time to get in. If anybody wants to get in on the cheap, our average share price, unfortunately, is $29, but we wanted to get some of the dividends before the X date. So, it's all good. It's a very, very small portion of our overall complete set of portfolios that we have. Very, very tiny percentage, so we're not too concerned about it. But so your support's somewhere around 18 to 1850 and resistance somewhere between 22 to 2220. Aptly still kind of sitting on this macro support here at roughly about $18 to 1850. The previous zone we want to get back up to here is roughly about $20, and then we can talk about getting into the next zone. ORC, it's still kind of not really doing much. I mean, it is respecting this overall downward channel. So generally speaking, a downward channel is a bullish indicator. So usually what happens is that more often than not, a downward channel will break out to the upside. I'm pretty sure we've told you guys this before, but that is a bullish trading pattern. The opposite would be true if it was an upward channel. Expect a breakdown to the downside at some point. But we haven't seen that yet. We're kind of just sitting around the zone. So ideally, we want to get above 1470, and then we could be looking at getting past this, the top of this channel here, which is about 1550 a share, which we have not seen yet. And then we get up to 1760 to 1780, and the bottom of this channel is sitting roughly at about $10.50 per share. I don't think it's going to go that low, if I'm being completely honest. So the next one would be AMZ, kind of just in no man's land right now. Support is between 1975 to 2010, resistance between 2180 to roughly about $22 a share. Going to FB is still doing really good, so we're sitting at support here, roughly about 2070 to 2098 per share. I know the dividend for FB has been pretty good, so that's something to consider. Let's see, GUI. GUI, surprisingly, even though it's kind of come down below this support level here, it's kind of actually respected it. So I think this is probably actually going to move this and make it a bigger support zone. So somewhere between 1750 to 1850 is the actual support. And then to get up to this previous resistance, it's about basically 1960 to $20. GUI is one that we do own quite a bit of. We told you before that we were very bullish on Google in 2024 and 2025. All I'm going to say about that right now is part of the reason being is because of their new AI that they recently released that everybody was fake, or everybody believed it was fake. All I can say is we have been more bullish on AI coming from Google than any other Magnificent Seven company, with the exception of NVIDIA. But they make chips. They don't, as far as I know, they don't make the actual AI itself. But then again, I could be wrong. Maybe they do. But in terms of AI itself, NVIDIA and Google are our two top picks. So MSFO, this is the Microsoft one. Support sitting here between 2084 to 2118. Resistance between basically about $23 to 2310. It seems like MSFO has held up pretty well. So now we have here the DSO. This is the Disney one. So support here is, you guys can see these wicks are getting, this is basically a buying pressure. This indicates that people are willing to buy this dip. So you got 1930 to about 1980 at support and 2050 to 2060 at resistance. If you guys were going to buy and sell these would be your general buy and sell zones. And then above that would be 2160 to roughly about 2180 a share. NVIDIA has held up quite well, actually. It's not really doing much. Again, knock on wood, we're not trying to jinx anybody here, but support is between 1960 to 2030, and resistance is between 2380 to roughly about $25 a share. Enfley has actually held up really well since this bottom. You guys remember we bought back here when we said we were going to buy this dip because we thought it was a great time. It turned out that was actually true. At least so far anyway. So support between 15 to 1560 and resistance is between 19 to about $20.30. This one's kind of in no man's land. It's not really doing much of anything, which would indicate that Netflix is not doing much of anything. So Zomo, this one's kind of gotten beat down quite a bit. Again, there's multiple reasons for that. One of the reasons is because the U.S. is producing record numbers of oil per day. I think it's like 13 billion or 13, no, not 13 billion, 13 million barrels of oil per day. And the Saudis kind of tried to restrict the oil flow or the amount of oil they were producing. So the U.S. just said, screw it, we're going to come out and produce more. And then that would be part of the reason why ExxonMobil has come down, because again, when you produce more of something, there's more of it, the value is generally less. And when there's less of it, like Bitcoin, for example, the value is generally more. So that explains why the price of Zomo has come down. But in my opinion, I would say Zomo right now is probably a good buying opportunity. So PYPY, this is the PayPal version. Not really doing much, just kind of stuck in between these two zones. So 1750 is support, 1775. And then you got 1990 to roughly about 2030 for resistance. Again, I would say on the underlying for PayPal, it is much more undervalued than something like NVIDIA or Microsoft. Just something to keep in mind. So AMDY is sitting on support here. Support is between 2050 to 2120. And the resistance would be somewhere between $23 to about $23.80. JPMO, also basically stuck in no man's land. So 1830 to 1860 is going to be your support, and 2040 to 2065 will be resistance. Squee, very similar to Coney, it just had an absolute dump take place. But again, we'll take a look at the underlines for all of these YieldMax funds in a later video. But when you look at the underline, it'll make sense why these dumps took place. So your support is between 2030 and 2130. And your resistance zone, I go ahead and draw that in real quick, is going to be basically somewhere between $25 to roughly about $26.50 a share. So AIYY, that we know that this one's relatively new. Again, this is not a massive company like Tesla or something like that. This is kind of more of a mid-cap size AI company. It has fallen underneath the support, unfortunately, so we'll kind of have to wait and see how this one plays out. We'll let you guys know more detail in the underlying video when we do it. And Murney, this is the Moderna one. Looks like it's coming back to retest the EMAs, but basically your support that you're looking for here is roughly between 1950 to 1972 per share. And the resistance would be somewhere between 26 to roughly about 23.70 per share. So do I still think that the YieldMax ETFs are worth buying? The short answer is yes. Look, you guys got to understand something. Are these going to be like 20, 30, 40-year growth stocks that are going to raise their dividends for the next 20, 30, 40 years like dividend growth stocks do, like Home Depot and PepsiCo and Walmart and companies like that? Probably not. I mean, these things pay huge dividends. We're talking between 30 to 60, maybe even 100%. If you want dividend growth stocks that are going to grow in value and capital value, but also raise your dividends slowly over time with lower yields, dividend growth investing is the way to go. This is why we have a portion of our money in the high yielding covered call ETFs. We have a portion of our money in monthly paying high yield dividend stocks that pay somewhere between, I'd say, like 7 to 14, 15%. So it's not super high, but it's not super low. And then we have a portion of our money in dividend growth stocks that have low yields, but they're also at a discount and they raise their dividends pretty much every single year, with the exception of a few recent dividend cuts. But you guys have to understand these ETFs for what they are, okay? It literally says in the prospectus, the primary objective, unquote, is to achieve income. That's the primary objective. Covered call ETF income, okay? Secondary objective, price exposure. You guys got to understand, if the price of the underlying goes up, the price of the YieldMax ETFs will go up too, but only to a certain extent because the upside is capped. That's how covered calls work. Okay, but if the price goes down, unfortunately, because of the nature of covered calls, the YieldMax ETF, whatever the particular one is, will go down in an equal amount. Okay. Now, in terms of the macros, like the Fed cutting rates and inflation and all that jazz, the most ideal scenario for the YieldMax ETFs to play out in terms of the macroeconomics, this is one of the reasons why we study macroeconomics so importantly, or it's so heavily, I should say, why it's so vitally important, because it allows us to, I'm not going to say see the future, but we can kind of more or less gauge what's coming and what to expect based on historical data by looking at the 10,000 foot view of the markets. Okay, a lot of people are not interested in this kind of stuff. They're like, yeah, whatever, that's garbage. We don't care. We just want, the passive income, or we want to know if price is going to go up. We take a look at the big picture stuff because it's vitally important, especially when the Fed is trying to fight inflation. So the most optimal scenario for these YieldMax ETFs to play out is simply the Fed cuts rates, the yield curve uninverts, and the markets go up. Historically speaking, the markets fall off a cliff when the yield curve uninverts, and that happens as a result of the Fed cutting rates, which we already know is right around the corner. But again, we've stated that the reason why we think that the markets are going to go up instead of going down is because we had two bear markets in the last 4 years. Okay, we had the 2020 pandemic, which was insane. Okay, we're living examples of people that bought the dip on that. The 40% drop in the S&P back when we were exclusively invested in index funds. And also the 2022 bear market, which is the main reason why we think stocks will go up in 2024 regardless, and 2025, and crypto as well, regardless of whether the Fed cuts rates or not, and at whatever rate they cut it. Now, in terms of the YieldMax ETFs and us buying them, we would be buying strictly just dividend paying stocks. We would put everything we have into dividend paying stocks and allocate a portion of our capital to swing trading stocks, small cap, highly volatile stocks within the traditional markets, except crypto is literally right around the corner. The crypto bull run is coming. The halving's in 3 months. And in roughly about 12 to 15 months, I would say, maybe even sooner than that, Bitcoin's going to blast past all-time highs. Altcoins are going to absolutely moonshot, and we're going to make a ton of money, a boatload of money, okay? So if it was not for crypto, the bull run coming up right around the corner, we would be fully invested in these extremely high paying covered call ETFs, in addition to a variety of other dividend paying stocks and ETFs that have more growth potential as well. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe. Let us know your thoughts below, and we'll see y'all later. Peace.